Crossroads. Joining us to talk about what this all means, here's Nomura's Asia ex-Japan chief economist, Rob Subbaraman. Rob, always good to have you with us. First off, what kind of trade numbers are you forecasting?
We're expecting exports to be up 20% in January year on year, so a pretty good number. But I think the real eye catch is going to be imports, which we think will be up 80% on the year. Imports very strong. We have to be aware, though, that there is a very weak base year effect. There's also Chinese New Year, which is in February this year, but was in January last year. So there's more working days in January this year than a year ago, biasing it up. And remember that January last year was at the height of the credit crunch, and so there was really a real dry up in demand for durable goods. And I think a lot of Chinese importers were really just running down their inventories rather than getting more imports to export. So I think there is a big base effect, but overall it's going to be a very impressive import number.
Is China at a crossroads at a crossroad right now? I mean, does it have to decide whether its economy will continue to be driven by exports, or is it getting too big for it to be relying on that? Domestic consumption will have to be, well, boosted as well.
I think that's right, Haslinda. This year, China in economic size is going to overtake Japan. We think it will be about a $5.5 trillion economy. It's getting too big a part of the global pie to keep relying on exports for growth. And so we do think there is going to have to be a lot more focus on policies to drive domestic consumption going forward. Interestingly, last week, China released its current account data. It only comes out twice a year. And for the full year of 2009, the current account surplus actually did narrow substantially to 5.8% of GDP. In 2008, it was 10% of GDP. So there is some sign that this rebalancing is happening. But going forward, I think rather than relying on exports being weak, it's going to be more trying to get imports stronger, and that means more consumption out of China.
Inflation, a huge concern. Is there a need for the central bank to tighten policies more aggressively?
We don't think so, although it is going to be quite volatile in the next couple of months. Inflation out later this week, we think is actually going to surprise on the downside. We're forecasting it to drop from 1.9 to 1.5% in January. But then in February, partly because of base effects of Chinese New Year, we think it will be back up over 3% and then come down again. But basically, underlying trend for inflation, we think is going to stay fairly low. And three reasons for that. In the manufacturing sector, there's been massive investment, so there's still sufficient supply. Productivity growth is extremely strong in China, and there's ample food stocks. Actually, pork stocks are at a record high, pig stocks. So we think overall, if you look at Chinese inflation, just like over the last 10 years, the only thing that's driven it up is food prices. And with a lot of food stocks available, we see inflation staying fairly low this year at 2.8% on average. So we don't see draconian tightening measures by China this year.
Rob, before we let you go, another concern, defaulting loans. Sounds like a crisis in the making.
I think certainly there has been massive new lending by China, and they are now starting to put pressure on the banks to cool down lending. This is certainly a risk going forward, but I think defaulting loans and becoming a real issue for the banking sector, that's not a story for this year, probably not even a story for 2011. It's more further out for that to be a story. If you go back to the last time in the 90s, when you had the investment boom in the early 90s, it took a lot longer before you had an NPL problem.
Thank you.